Today we'll be starting with hedging with futures of the derivatives portion. Okay, this is very much important for your exam and many times questions do come from this part. Okay, so listen to it carefully. Hedging uses, what is hedging? Okay, let me first explain what is hedging and then we will move on. Okay, so hedging. Okay, let's suppose this is a person, his name is A. Okay, he has 100 shares of Reliance Limited. Okay, he has 100 shares of Reliance Limited. Now let's suppose Reliance shares are trading at the rate of 2250. Okay, Reliance is trading at the rate of 2250. Now this person, he wants to he is fearing that, what is he fearing is that the price of Reliance Limited will go down. Okay, he wants to sell the share after 3 months. Okay, after 3 months he wants to sell the share, but what is his fear? He is fearing that the price of the share will fall to 2000 only. Okay, now he is fearing that. Now what, he has 100 shares in spot. Okay, he has 100 shares in spot. Okay, which means what, he has bought the shares, he has been delivered the shares, 100 shares, he is having 100 shares, but he is of the fear that the shares will go down, the price of share will go down. So what he does is that he goes to F&O market. He goes to F&O market and okay, so he goes to the F&O market, means what, he goes to the futures market. Okay, futures market, and there he books a short bet, means what, downside bet. Okay, short bet means what, downside bet means what, he is betting that the price of the share will go down. Okay, now what will happen is that when he bet this much amount, okay, which means what, short betting means what, downside betting means what, when the price of the share goes down, he will earn the money. Okay, he will win the bet. Okay, let's suppose he gains profit. Okay, he gains profit, and the shares which he has already in his demat account, there he'll face loss. Okay, now this both loss will be set off. Okay, these both loss will be set off. Okay, now this is called as hedging. Okay, now let's suppose the price did not go down. Okay, the price shot up. Okay, now what happens if the price goes up? Okay, then here let's suppose the price is 2500. now what will happen is that he will gain. Okay, he will gain here. Okay, minus 2250. Okay, now he will gain this much amount. Okay, 250 rupees he will gain per share, and here he will lose the bet. Okay, now what is the benefit of hedging is that he will not face any loss. Okay, no loss will happen. Okay, even if loss happens, it will be very much minimal. Okay, and if there is gain, there it will be very much minimal. Okay, he cannot gain more. Okay, he cannot gain less, he cannot lose more. Okay, now this is the basic concept of hedging. Now you tell me, how many contracts should I buy? You know what is a contract, right? A contract means number of units now I want to see that how many units should I buy. Okay, now I want to see how many units should I buy. Okay, so what am I doing is that how many contracts should I buy? Okay, what is a contract? Contract is number of units into minimum lot size Okay, number of units into minimum lot size. Okay, that is one contract. So how many contracts should I buy in this? Okay, so how will you calculate it? There is a concept called as beta. Okay, there is a concept called as beta. You might have learned in the portfolio chapter. Okay, so if you have not done the portfolio chapter, please do that first and then come to derivatives. Okay, so what is beta? Beta is how much the share moves with respect to the market. Okay, so let's suppose the beta of Reliance share is 1.2. Okay, which means what? When the market moves by one step, beta of that is the share of Reliance will move 1.2 steps ahead. Okay, if the share market falls, okay, if the market falls, then what happens? Falls by one step, then the share of Reliance will fall by 1.2 steps. Okay, this is the basic concept of beta. So how is the formula? How can we find out how many number of contracts we need? It is simply, okay, 100, right? 100 into 1.2 into 2250. Okay, right? 100 into 1.2 into 2250. Okay, which means what? The value of shares into the beta of shares, existing beta of shares, divide by contract value. Okay, divide by contract value. Okay, let's suppose the contract value is of 200 shares and one futures contract is 1000 rupees. Okay, so how many contracts do we need? It is very much logical. Okay, into 100 into 1.2 divide by I need 1.35 contracts. Since the contract cannot be in decimals, so it has to be in round figures. So what it is, it will be, you have to do upward rounding off. That is, it will become 2. Okay, so this is the basic concept of hedging. Like this, many contracts, like this, many type of sums will come. This is known as how to find out the number of contracts. Okay, now I have found out number of contracts. Now what I want is I want to find out the profit or loss. So how will I find profit or loss? If the share would have gone up, okay, if the share price would have gone up, which means what? We will gain, okay, and since we are hedging, which means what? We will take opposite position in the market. Okay, whatever we are fearing, we will take their position. Okay, since we are taking opposite position, there we will face loss. Okay, one side we are gaining, one side we are facing loss. Okay, in that case, how much is the gain or loss? Now you might ask, how can we get gain or loss? Okay, see here. Now how many contracts did we need? Only 1.35. But how much did we purchase? How many did we purchase? We purchased 2 contracts, right? So like that, if it is extra, we will face some loss or some gain. Okay, but it is far more better than being in the anxiety of the price falling down. Okay, so these are the basic concepts of hedging. Okay, now I will tell you, read it from the Ajay Agarwal sir's note, then we'll get some clarity. Okay, hedging using respective share futures. Okay, so what I did was, okay, what do you mean by share future? I'll explain it to you. Okay, there are 2 markets. Okay, the first one is your spot market. Okay, spot market means what? Here delivery is done of the share, which means what? A share unit is allotted to you. It is transferred to your demat account. This is known as spot. Okay, and the another one is your future, which means what? No delivery is done, only cash settlement is done, right? This is a different concept. Okay, cash settlement is a different concept. Delivery can also happen in future, but mostly in our case, while doing hedging, it will be of cash settlement only. Okay, which means what? This future market, it is different. Okay, it is different from your spot market. Okay, so this, both of these markets price will be different. Okay, this will be different and this will be different. Okay, how much it will be different, we have learned in theoretical fair value price. Okay, theoretical value of the share of the future price, that we have learned. No, so it will be equal to that only. Okay, always you see your futures will be different than your spot price. Okay, now what we'll do is that I took an example of Reliance share, right? Reliance share is a big company, so its futures will be listed in the stock market. Okay, its futures will be listed in the stock market. Now I don't know about the Indian market of these stocks. So when you see of cryptocurrency, what happens is that BTC spot, Bitcoin, okay, Bitcoin spot trades differently and Bitcoin's futures trade differently. Okay, both of these prices are different and both of these market are different. Okay, so this part deals with the let's suppose I have one Bitcoin. Okay, I will take futures of short position of one Bitcoin. Okay, spot I have different and futures I have different. Okay, you have to understand this concept very well. Okay, so hedging using respective share futures. If you have long position on share, then create short position on shares in the future. Okay, future market and spot market are different. And if you have short position in the of the shares of the company, then create long position. Okay, go in the opposite direction. Okay, or do whatever you fear. Next, hedging using index futures. This is what asked frequently in the exam. Okay, which means what? I am having a small company share. Okay, now those small company share might not have its individual futures market, right? Futures price will not be available. So what we'll do is that we'll take the index. Okay, index means was what? It is your Nifty and Sensex. Okay, Nifty means what? Your top 50 companies listed in the stock exchange, right? So top 50 companies index will take into consideration, which means what? If we have 100 shares of a small company, then we'll take short position of index in the futures market of the equivalent value. Okay, so I already have a long position and I'll take short position. Okay, so it is used to hedge portfolio of shares or shares of the company for which respective share futures is not available. Okay, portfolio of shares or shares of a company for which respective shares is not available. Okay, so if there is a why is here given portfolio of shares? Let's suppose you have 5 securities in a portfolio. Okay, now you will do hedging of each and every security of the portfolio. What? Okay, each and every securities future you will trade about. No, that is practically impossible. Okay, it is possible, but it's very much magajmari. So what we'll do is that we'll directly take index position. Okay, short position, long position, whatever thing we have. Okay, whatever fear we have, we do that. Okay, take opposite position. Okay, and shares of the company which for which respective share futures is not available. Okay, if for a company there is no shares future available, we will take that position. Next, steps to be followed to solve the questions. Now we are directly talking about steps. No faltugiri, nothing, just steps. Apply these steps, you will get the answer. Okay, so it is covered in 4 steps. Very much easy, very much easy. Believe me, just apply your common sense, you will crack it. Okay, now let us see what it is. First one, which position should be created in the index futures? Okay, if you have long position, create short position. If you have short position, create long position. Okay, go in the opposite direction. Okay, I am not reading this. Okay, just keep this in mind. Okay, very much basic. Okay, which means what? You have one shares portfolio, okay, you already have a shares portfolio, means what? You are already having a long position in it. Now what you will do, you will take short position in the futures market. Okay, so this is the first step. Okay, now you have to, first step is deciding which position you have to go. Okay, if you choose the wrong position, then the entire sum will go wrong. Okay, so do this conceptually. Next, number of index futures or contract to be bought or sold. As I told you, beta into your value of shares, okay, divided by price of one future contract, right? Price of one future contract. Okay, in my example I already, right, I was doing right only. 1000 shares we had, 1000 rupees was the price and 200 was the lot, so we did correct only. Okay, no need to take tension. Okay, so price of one future contract will be in the denominator. Now value of shares into beta of the shares. Okay, so which means what? Existing beta. Now here in the formula you will see required beta also. Okay, now you will tell me that I didn't explain it. Okay, which means what? Beta means what? Beta means your risk, right? So if you want full hedging, means what? You want full hedging, then you will do existing beta. You will take total value of the shares. If you don't want full hedging, then what you will do is that you will minus the required portfolio. Okay, you will minus the required beta. Okay, now you want to minimize the risk. Let's suppose your beta of the shares portfolio is 1.2. okay, you want to take it to 0.91, means what? You are willing to take the risk of how much? 1.2 minus 0.9, right? You are willing to take the risk of 0.9. okay, so how much extra do I need to pay? It is 0.3, right? So that is the basic logic of this. Okay, we have one question in the past year paper or your RTP. Okay, I don't remember it clearly, but there we had this point. Okay, it was very good. If possible, I'll try to solve it. Okay, so existing beta minus your required beta means what? How much risk are you willing to take? Okay, if no required beta is given, which means what? You are willing to hedge, you are willing to safeguard your position fully. Okay, so if required beta is not given in question, don't assume anything, assume it as 0 only. Okay, if number of contracts comes in decimals, then round off to upper side of the whole number. Okay, in our example it was 1.35, we rounded it off to 2, right? So next point we have is step number 3. It is calculate overall gain or loss on majority due to hedging. I already told you this in example. Okay, so it is what? Gain or loss on index future contracts. Okay, index future contract, we'll take one amount, and gain or loss on shares portfolio. Okay, this is your spot market and this is your futures market. You see the link, right? So the difference which we get, it is gain or loss. Okay, we'll try to bring it near to 0 only. Okay, now how do we calculate the gain or loss on index futures? Calculation of gain or loss on index futures is already discussed in the topic gain or loss, so we will not discuss it again here, but I'll tell you. Okay, so which means what? Gain or loss, you have to calculate payoff only here. Okay, now this payoff word is more important in your next part, that is your options. Okay, I'll tell you detail in there. Okay, here payoff means gain or loss only. Okay, but if rise or fall in price of index future is not given in question, then it will be equal to rise or fall percentage in the index market. Okay, as I told you earlier, future market is different and your index market is different. Index market is your spot market, index future is your future market. Okay, so index future and index market, they both are different. So how will you calculate index market? Okay, rise or fall in index market, how will you calculate? Rise or fall in shares portfolio divide by existing beta of shares portfolio. Okay. So how do we calculate it? Rise or fall in index market, how do we calculate it? So let's suppose rise or share in portfolio, it is 6%. Okay, 6% divided by your existing beta, it is, let's suppose, 1.2. Okay, so how much would be your rise or fall percentage in your index market? This is what we are trying. So do you know this is very much similar to you? Okay, now this is what rise or fall percentage, that is change in shares divided by your beta. Your beta is equal to change in market. Can you guess what formula is this? We have already studied this in portfolio chapter for finding out beta. Change in shares divided by change in market. We get beta, right? So this is the just different formula. Okay, just adla badli. Okay. So what answer will get? 0.06 divided by 1.2, it will be 0. So 5%. Okay, 5% will be the change in market. Okay, it is all basic mathematics. You will be able to solve it. Next we have is gain or loss on shares portfolio. Okay, so if we have long position on the shares portfolio, which means that we already have shares in the portfolio that we have already bought. In this case, if price of the shares fall on maturity, this is very much basic, I am not going to explain this. Okay, calculation of gain or loss, value of shares portfolio into rise percentage or value of shares portfolio into existing beta of shares portfolio minus rise or fall into rise or fall percentage. Okay, it is very much basic and very much basic mathematics. Okay, if you want, you follow this. I find mathematics very much simple. I find logic very simple. Okay. Next, calculate total portfolio beta on maturity after hedging. Okay, this step, calculate total portfolio beta. Okay, now there is a concept called as portfolio and total portfolio. Okay, now you have a demat account. Okay, demat account in Grow. Okay, in Grow app you have a demat account. Okay, now what is happening is that you have put money in the shares. Okay, you have put money in the shares. Okay, let's suppose your shares was 151 rupees and you have bought 10 shares. Okay, so 151 100 1510 is the amount you require. Okay, but you transferred how much? 2000 rupees. Okay, now what is happening is that how much is the difference amount? You have 490 in the balance in the cash account. Okay, in the account you have 490 rupees extra. No, so this is your cash balance, right? Is there any risk for this amount? There is no risk. Okay, it will stay the same. Okay, so whenever there is a risk, it is for the 1510 amount. 490 is very much safe. Okay, now what do you mean by total portfolio? It is 1510 plus 490. It is a 2000 is a total portfolio amount. Okay, so this is what is written here. Okay, total portfolio means what? The amount in your balance in the demat account. Okay, so how do you calculate total portfolio beta? It is total change in portfolio divided by rise or fall in percentage market. Okay, it is the same. Beta, sorry, change in market, sorry, change in security divided by change in market. You will get beta. Okay, so what is total portfolio? Total portfolio is change in total portfolio is gain or loss as calculated in step 3. Okay, divided by value of total portfolio at the beginning. Value of total portfolio is equal to investment in portfolio plus cash and cash balance. Okay, so how much change would have been occurred? Okay, gain or loss, we have in percentage only. We want in percentage, no? So that's why we are taking only gain or loss. Okay, divided by total portfolio at the beginning. It is very much basic mathematics. You'll be able to solve it. Next, note, cash and bank balance is risk free, as I told you. Beta of cash and cash balance is 0. Hence, it is not considered in the value of portfolio for hedging in step 1, 2 and 3. Okay, this is asked in only some questions. Okay, you have to keep this in mind. There is an example here. We will not do example. I'll explain arbitrage side by side only. We will cover that also in the questions. Okay, what is arbitrage? Arbitrage is the you are taking benefit of the mispricing in the market. Okay, you are taking benefit of the mispricing in the market. Okay, it is known as arbitrage. Okay, how do we calculate value of futures? It is S into ERT, right? So that is how you calculate your futures value, right? You calculate your theoretical value. But is it compulsory that your actual quoted price, which is actually trading in the market, and your theoretical value should be same? No, it will not be the same. Okay, it is not mandatory to be the same. If it is not same, then we will take some steps to earn riskless profit. So how it is, we'll see. If actual quoted trading price of future, okay, if actual quoted price is more than your theoretical fair value, okay, if actual is more and theoretical is less, which means what? Here in actual market, it is overvalued. Okay, so what we'll do, the arbitrager will do cash and carry arbitrage. Okay, this method is known as cash and carry arbitrage, which means what? We will create short position on future, which means what? We will sell future. Okay, since it is overvalued, we will sell. It is the same concept as your security valuation. If it is overvalued, sell it. If it is undervalued, buy it. No. Okay, if it is opposite, okay, which means what? If the actual quoted trading price is less than the theoretical fair value, then it means what? It is undervalued. In the market, it is selling less, and in my theoretical fair value, it is more, which is what? It is undervalued. Then we will buy it. Okay, then we will take long position. Okay, then we'll get gain. In the both side, we'll get gain only. Okay, so this was an easy part. It is not generally asked in question because in exam, because it is very much easy. Okay, so we'll see questions of it. Questions are good. Okay, questions are good and very much easy. If you know mathematics, you will be able to solve it. Just focus on mathematics. Derivatives, hedging. Okay, question number 8 is very much easy. Just follow concept notes and apply logic. You will be able to do it. Okay. Now, this is actually an exam question. Okay. They have asked here beta of portfolio. No, in exam, the security A's part was missing. Okay, reverse calculation will be asked. Okay, it is very much easy. Okay, you just have to know mathematics. It is quite time consuming, but you will be able to solve it. Okay, so what to do in exam is that whenever you get a paper, okay, and you are saying that there are reverse calculations in the question, first choose those questions which are very much easy. Okay, and straightforward calculation which you have already solved it. Okay, solve that fatafat in 1 hour, and then devote the next 2 hours for those questions which are twisted or which might take more time. Okay, go in that order. Now, on January 1st, an investor has a portfolio of 5 shares as given below. Okay, this is the portfolio given. Now we have to find what? Beta of his portfolio. So how will we find it? 349 into 5000, we'll get an amount. Okay, market value. Okay, and what we'll do is that we'll take weight of it. Okay, weight into beta, we'll get beta of portfolio, right? It is very much easy. Now, theoretical value of Nifty futures for February 2025. Okay, now 1st January is given and theoretical value of Nifty futures for February 2025 is given. Okay, there is no date given here. Okay, of which date of futures of February we have to take. So number of days in a year to be treated as 365. Okay, so we'll take 365 as the date. Now how many days? On 1st January he has a portfolio. Okay, now we have to find out theoretical value. Okay, ignore the first date, 31 minus 1 plus 28. So 58 days we have, divided by 365 into what is the time, so what is the rate of interest? It is 9.98. okay, continuously compounded. Okay, since it is continuously compounded, 9.98 per annum, no, so 0.0998. So it is 0.158586. okay, 0.15858. okay, we have here E, so we'll take directly this amount. Okay, spot into this amount we'll get the answer. Okay, 1.01598 into spot value. What is my spot value? The current value of Nifty is 5,900. okay, so 5,900. so my theoretical fair value is 5994.282. okay, it was also very much easy. The number of future contracts of Nifty the investor need to sell to get a full hedge until February. Okay, now they are asking about full hedge. So what we'll do, existing market value of shares into existing beta. Required beta is not given in question, so we'll assume it as 0, into existing beta divided by your theoretical value into your number of units in a contract, into 200 will do, into 200. So this will be my one futures contract price. Okay, above what we'll have is that this price into number of shares will get a total amount, no, into the beta. Okay, portfolio beta divided by this amount will get the answer. Okay, as the number of contract. Next, number of future contract the investor should trade if he desires to reduce the beta of his portfolios to 0.6. okay, now what this guy saying is that we would have gotten a portfolio. Okay, he wants to reduce the beta of his portfolio to 0.6. means what? Is ready to take a risk of 0.6. so this beta minus this beta into the, that is your existing beta minus your required beta into your market value. Okay, divide by the contract. Okay, fair value into your contract size, lot size. Okay, then we'll get the answer. In exam it was asked very much twisted. It was a good question. Okay, so like that only. Okay, we got value, we got weight beta into beta, we got portfolio value. Okay, portfolio beta, and ERT, as I told you, 5994.28. we got the same answer. Value of total portfolio, value of spot into portfolio beta, existing beta divided by your value of contract, 594 into 200, right? The same we got. Number of contracts to be sold, existing beta minus your required beta divided by the total contract. Okay, we got the same, right? So in exam what they asked is what? They gave the total contracts here and they asked us what is the required beta. Okay, in question it was asked like that. In exam it was asked like that. Okay, so just put it in the formula, you will get the answer. Now question number 9 will do. On 1st April 2025, an investor has a portfolio consisting of 8 securities. Okay, it is the same question, I guess. Okay, beta value is given. Now, the cost of capital is 20% continuously compounded, which means what? Spot into ERT, right? If you want to find out theoretical fair value. The investor fears a fall in the prices of the shares in the near future. So what he'll do? He'll take index futures. Okay, short position he'll take. Accordingly, he approaches you for the advice to protect the interest. The current Nifty value is 8,500. Okay, the Nifty futures can be traded in the 25 units. Okay, futures of May is 8,700. Actual quoted price are given, and futures of June are being traded at 8,850. Okay, now we have to calculate beta of this portfolio. How you will calculate beta? Market price into number of shares. Okay, and we'll calculate weight into beta. We'll get beta of portfolio, right? It is very much easy. Next, they are asked us to find out the value of futures for contracts expiring in May and June, right? So they have asked us theoretical value of futures for contracts expiring in May and June. Okay, May 1 is quite important. So first we'll solve June and then we'll go to May. Okay, so first June. I have underlined May and did a star mark. It is a very good question, very good part. So we'll do June first. Okay, so June, how will we calculate June? So spot into E into R, spot ERT, right? So 8500 we have as a spot, and next we have to take what? We have to take ERT, right? Now 3 values are given. Which one to take? I don't know. So we'll do RT. What is my rate of interest? It is 0.2, right? 20% into, for June we are taking, no. So what is the current date? It is April, May, June. Okay, 3 months contract. Okay, there is no number of days given here, so we will take months only, into 3 divided by 12, right? 3 months divided by 12. So it is 0.05. Okay, so 0.05 we have, yes, 0.05 we have, 0.01527. We'll take directly that. Okay, so 1.05127 into 8500. So 8935.79 will be my futures theoretical value. Okay, for June. Next they have asked us for May. Now May, what is the catch here? Okay, so now start. I'll tell you what is the catch. Okay, we'll start solving it. Okay, now ERT we have to find. R is what? 0.2 into RT. T is what? For May, no, for 2 months only. April, May, 2 months into 2 divided by 12. Now I'm getting the value as 0.33333333. Okay, now here it is not given 0.333. 0.3 is given and 0.4 is given. Now my value should lie in between this value, right? Between 3 and 4 my value should lie. Okay, so how do we calculate it? Okay, let's see. 0.33 we have, no. So we'll apply unitary method. Okay, so how do we calculate it? E 0.03 is equal to 1.03045, right? E 0.04 is equal to 1.04081, right? So in between this we have. Okay, so how much do I need? 0.33 I need. Okay, 0.33 I need. Okay, so 0.33 we need, right? So how do we calculate it? Now we will calculate the difference between it. Okay, so 1.0345 minus E 0.04. Okay, between this value should lie, no, minus 1.04081. Okay, now the difference between this is how much? 0. Now I'll draw a diagram. Okay, 0.03, 0.04. Now the total value is how much? 0.01036. Okay, now do I need the whole of this amount? No, I just need a part of it. Okay, now here will lie our 0.33, right? 0.033. Okay, now here will lie my 0.033. Okay, now I have to find this part. Okay, now this is 100% and this is 33%. Okay, so into 33%. Okay, I got this amount, plus I do what? 1.0345. Or you can do the different also, minus 1.1045 minus that amount. If you do, okay, minus 0.07, then also you will get the same answer. Okay, now what is my amount? It is E 0.033 is equal to 1.03387. Okay, this I should use. Okay, 7 into what? Into my spot price. Okay, into 5,800, right? Sorry, 8,500. So 8788 should be my May's value. Okay, my May futures is how much? 8987.90. Okay, close to that, right? Understood, no? Next, the number of Nifty future contracts that he would have to sell if he desires to hedge until June in the each of the following cases. Okay, the number of Nifty future contract he would have to sell if he desires to hedge until June in each of the following cases. Okay, means what is that he desires to hold his hedge for how much? Till June. Okay, till June he wants to hold this hedge. Okay, so how do we do? Okay, the number of future contracts we have to buy. The first one is total portfolio. He has to hedge his total portfolio. So what we'll do, June's value will take. Okay, what is the June's theoretical value? June's theoretical value should be, June's value is 8935.80. Okay, we already calculated it. 8935.80, right? Into my existing beta. Sorry, this is my value. It will come in divide. Okay, 8935.80 into how much is the Nifty futures? It will be 25 units. Divide upside, what we'll have the total shares. It is how much? Market value 994450 into my portfolio beta. My portfolio beta is how much? 1.102. Right, so I'll get the answer 994 it is 4.9 or 5 contracts. Okay, this was very much easy. Okay, now the next two is 5 contracts. Okay, now the next two, it is also very much easy only. Okay, so we'll see what it is. The next one, it is B is equal to 50%. Okay, 50% of his portfolio he wants to hedge. Means what? 994450 into 50% into 1.102 divided by 8935.80 into 25. Okay, in exam, even if you write this calculation, you will get the full marks. Okay, you need not to write all the explanation there. Okay, what is it, you need not write it, just write calculation, you will get the marks. 994450 into 50% it is almost 2.45 or 3, right? So C part, he wants to hedge 120% of his portfolio. Means what? 120% into the 994, okay, into beta divided by the same thing. Okay, it is very much easy. Okay, only one part was a tricky, that is the May part that I already explained. Okay, this was a fairly easy question. Okay, now we'll move on to the next question, question number 10. Okay, on 1st July, what is happening is that P has made the following investment. Okay, he has purchased a company named ML Limited. 1000 shares he has bought, having beta of 1.25. Okay, purchase price per share was 700. Okay, he wants to hold investment till end of September 2025 with an expectation of huge dividend to be announced. Okay, so he wants to hold till September. Means what? July, August, September. 3 months he wants to hold. Now on the date of investment, September Nifty futures are quoting at 17,500 and tradable with a lot size of 50. Okay, Nifty futures amount is given and lot size is given. Okay, now you are required to advise Mr. P. Please advise Mr. P how to hedge his market exposure and calculate the number of future contracts to be bought or sold using the available data. Okay, so which position should he take? He already has a long position, so he he has to take short position. Okay, number of contracts, how much he has to take? It is 1000 into 700, right? So 7 lakh into 1.25. This will be his amount in the above. Divide, it is 17500 into 50. Okay, you will get the number of contracts. He has to sell the data. Short position he has to create. Calculate profit or loss of Mr. P on expiry of 2025 futures if the following situations arise. Okay, now Nifty futures rise by 10%. Okay, now what is happening is that question number 10, a Nifty future rise by 10%. Okay, so how much contract are we taking? We are taking only one contract. Okay, now Nifty future rise by 10%. Means what? 17500 plus 10%. We have to calculate profit or loss. Now 19520, right? 250 minus 17500. So 1750 into how many units? 50 into 1. Right, so this will be his profit. 87,500 for Nifty futures. Right. So for spot market index, how much he would have earned? Nifty futures are rising by 5%, 10%. So how much will be the rise in share market? Okay, so how much did he have already? He had 1000 shares. Okay, into, now his beta value is 1.25, right? So see, futures, what he had? Futures he had loss, right? He had loss because he took a short position, right? Since the futures value is increasing by 10%, then he'll face loss. Now we have to find out the spot value where he would have gained. Okay, 1.25 is the beta value. So how much more? How much was the rise? 10%, right? So 10% into 1.25. This would be my rise. Okay, into how much? 700, right? So 700 into 10% into 1.25 into 1000. So 87,500 I am gaining. Okay, so this is nil, right? No gain, no loss. Okay, next we have is that share of ML falls by 5%, right? If it falls by 5%, then what will happen? Okay, so what will be the beta? What will be the effect in beta? So beta is what? Change in security by change in market, right? So 5% beta is how much? 1.25, right? Divided by change in market. So change in market is equal to 5 divided by 1.25. 5 divided by 1.25. So 4% there will be change, right? So Nifty, how much would be the difference? Gain or loss? Since it is falling, we have already created a short position, then we'll gain. Okay, so 4%, right? 17,500 minus 4%, right? Into 4% into 50. 17,500 into 4% into 50. So I am gaining how much? 35,000. Now shares. Shares of ML Limited is falling by 5%. Shares of ML is falling by 5%. So how much? 700 into 5% into 1000. Right. It is 35,000 loss. So here also it will be nil only. Right. Next we have a C part. Is it possible for stock as well as Nifty to raise or fall in the same percentage? It can fall, okay, if the beta is 1, okay, but practically it is not possible for beta of any company to be 1. Okay, so practically it is impossible. Theoretically it is possible, which means what? If beta of the security is 1, then there will be same. Okay, so no, it is not possible for the stock as well as Nifty to raise in the fall because of systematic risk. That is, beta might not be the same as of market. Okay, next we have question number 11. Question number 10 was very much easy. Okay, now we will move on to question number 11. A mutual fund is holding the following assets in crores. Okay, so investment in diversified equity shares 90, cash and bank balance 10. Okay, which means what? It is having in the account of the demat. Next, the beta of equity shares portfolio is 1.1. Portfolio beta is given 1.1. The index futures is selling at 4,300. Okay, index future is also given. One index future consists of 50 units. Okay, so 50 into 4,300 should be my one contract value. How many index futures should he short sell for perfect hedging? Okay, now how will we calculate the number of contracts? Should I take 100 or 90? If you are telling 100, please revise the concepts. Okay, cash and cash equivalent is having zero risk, so we will not hedge it. So 90 into 1.1 divide by how much? 4,300 into 50, right? So it is how many index futures should be bought? It is 4604.65 or 4605, right? So see, 4605 units we have to buy. Next, the fund manager apprehends that the index will fall at the most 10%. Substantiate your answer assuming the fund manager's apprehension will materialize. Okay, the fund manager is expecting that the index will fall at the most by 10% only. So we have to substantiate our answer assuming. So what we are trying is that the index will fall by 10%. We have to see if we are gaining or loss. Okay, so that is what they are asking. Index will fall by 10% means what? This is index. Okay, index future, no. Index is falling by 10%, which means what? What is the fall in market? It is 10 divided by 1.1, right? So market will fall by 9.09. Okay, so 4,300 4,300 minus 9.09%, right? So 3909 should be my market value, right? So gain or loss, how much should it happen? Okay, we are already created short position, right? Because we are hedging, I'll write it and show you. Okay, question number 11, right? Question number 11. No, we'll just look at this solution. Okay, loss in the value of share portfolio by 10%. Okay, 9.90 crores, 90 crores we had. Okay, cash value will not decrease. Okay, so how much does it fall? If the index falls by 10%, oh my goodness me, we have interpreted it differently. Here index future should come. No man, it is not right. So 1.1 into 10 into 90. So 9.9 crore it will fall. Loss we'll have in the shares. and gain by short, it is how much? 4300 into 50 into 4605 into 10% divided by 1 crore. It is 9.90, the same amount. Okay, it is 0. Now they should have given us 1.10. Okay, sorry, they should have given us index future and not index. Okay, this is very much wrong, but still. It was a mistake of interpretation and not logic. Next, question number 12. BSc we have. Okay, this is a good question. Only 2-3 questions are left. We will solve it fatafat. Question number 12. BSc is given as 5,000. Value of portfolio is 10,10,000. Risk free is given 9%. Dividend yield is given 6%. Beta of portfolio is given 1.5. Okay, so question number 12. We'll write the basic information. So what is my effective interest rate? My effective interest rate is equal to how much? 9 minus 6, that is equal to 3%, right? BSc is 5,000. We assume that the future contract on the BSc index with 4 months maturity. Okay, we assume that future contract on BSc index with 4 months maturity. Okay, its maturity is 4 months, is used to hedge the value of portfolio over the next 3 months. Means what? We are using 4 months future for hedging 3 months portfolio. Okay, so how much do we need? We need only 3 months of hedging. Okay, one future contract is for delivery of 50 times the index. Okay, so contract value is how much? Contract value is equal to 50 into 5,000. Okay, so it is how much? 5,000 into 50, it is 2,50,000. Okay, let's assume it as rupees only. Okay, next, based on the above information, calculate price of future contract. So can we calculate price of future contract? So future is equal to S into E. Information is not given, so we'll simply take 1 plus R into T. Okay, so S is my 5,000. Okay, into 1 plus R. What is my R? It is 0.03. We calculated here, no? 3% effective interest. Into T is how much? T is 4 months. Okay, we are just finding the value of future contract. Okay, the price of one future contract we are calculating. So 4 divided by 12, right? So it should come 0.03 into 4 divided by 12 plus 1 into 5,000. It is 5050. Okay, my price of one future contract is rupees 5050. This is my first part. Next. Sorry, they have asked one future contract. No. So contract is how much? So 5050 into how much? Into 50, right, is equal to 252 500. Okay, so this is not relevant, this is relevant. Okay, so 2,500, 2,52,500 is my contract value. Next we have is the gain on short futures position if index turns out to be 4,500 in the next 3 months. Okay, so we have to find out the gain on short futures. Okay, we already have a value of portfolio. So for hedging, we will take a short position. Okay, so we took short position. Now what will happen? The gain on short futures position if index turns out to be 4,500 in the next 3 months. Okay, means what? Now here, what does index mean? Okay, index means normal index. Okay, to calculate gain, what do we need? First of all, we need the number of contracts. Okay, now what we need is that we need index, future index, profit, okay, by short. Okay, by shorting, how much can we make? And next, spot value, gain or loss. Okay, so we need both these items. Okay, since it is 4500, it will probably in loss only. Okay, so how much is the loss we are going to calculate? Okay, for that future index, how many future index do we need to hedge it properly? So it is how much, the value of portfolio is 10,10,000, okay, into 1.5 is my beta, divide by how much, 250 to 500. This is one future contract value. So how many contracts do I need? Why am I doing 1.5? Because to make it equal to the index, market index. Okay, 10,10,000 into 1.5 divided by 250 to 500. It is coming to 6 contracts. Okay, 6 contracts. Now 6 contracts into how much gain am I making? So 5050 minus now what do we take here? What is the amount here now? 4,500. Should the amount here be 4,500? This much. Should the price here be 4,500? No. Here they have clearly stated here that the gain on short futures position, if index turns out to be 4,500, means what? Your spot price is 4,500. Okay, so 4,500 is your spot price into 1 plus R. R is my 0.03 into now how many months? Now we are again finding the fair value. Okay, so how many months are remaining? Just 1 month. 3 months have already elapsed, so just 1 month is remaining. Okay, so is equal to how much? So 0.03 into 1 divided by 12. Finally, I hit that mosquito. Okay, is equal to 0 plus 1 into 4,500. So the price of one future contract after 3 months is 4511.25. Okay, so this was the catch here. Okay, so minus 4511.25. Okay, so we'll get the answer minus 5,500 into 6. Now my one contract value is 6 into how much? 5050, right? Sorry, into 50, right? Yes. So 2996625. Wait a minute. Into 50. Okay. So we'll calculate again. 5050 minus 4511.25. Now why have I added 50 here? Because in one contract there are 50 units. Okay. 5050 minus 4511.25. So it is 161,625. Okay, what is my spot value? Gain or loss? They have just asked us the gain or loss on short futures position. Okay, so we need not do this. Okay, so just one thing here. Okay, we'll get 4 marks here. Okay, so this was a 4 marks question. We'll get full marks here. Okay, so it was a good question. Okay, this part 2 was good. Okay, index terms. Index means what? Here it means fair value, spot value. Okay, now question number 13 is very much easy. It's very much illogical. It will never come in exam. Hopefully you can do it yourself. It is very much easy. They have just asked us to find out which position on index future to complete hedge against the following transactions. Okay, to hedge, what position do we need? Short position, long position, whatever. Okay, it is very much easy, you'll be able to do it. So I'm skipping that. Question number 40 is easy and logical. We'll see what it is. Ram buys 10,000 shares of X Limited at a share price of rupees 22, whose beta is 1.5, and sells 5,000 shares of A Limited at a price of rupees 40 per share, having beta value of 2. Okay, there are two shares. Okay, there are two companies, company X, company Y, company X Limited, Y Limited. Okay, and the price, MPS is how much? 22, and here it is 40. Beta is your 2 in Y Limited, and in X it is 1.5. Okay, how many number of shares? Number of shares is 10,000 in X and 5,000 in Y. Okay, now he closes out his position at the end, at the closing price of the next day, when the shares Nifty future is 1,000. He obtains a complete hedge by Nifty futures 1,000 each. Okay, means what? He is already having the share. Okay, he has already bought the share. Now he wants to hedge, means what? He wants to take a short position. Okay, Nifty futures value is 1,000 each. He closes his position at the closing price of the next day, when the share limited dropped of X Limited dropped by 2%, and the share of A Limited appreciated by 3%, and Nifty futures dropped by 1.5%. What is the overall profit or loss to Ram? Okay, so first we take what is the portfolio value. Okay, so how much is the portfolio value? 10,000 into 22 equals how much? 2,20,000 in X Limited, and Y Limited it is how much? 5,000 into 40, right? So it is 2 lakh. So his total portfolio value is how much? 4,40,000. Okay, but he wants to take hedge. Now what he'll do, since both the betas are different, we have to take different position here. Okay, now we'll calculate the number of contracts to be purchased. So number of contracts is equal to how much? 10,000 into 22 into 1.5 divided by 1,000, means what? 10,000 into 22 into 1.5 divided by 1,000. It is 330 contracts. X and Y. 5,000 into 40 into 2 divided by 1,000 is equal to 5,000 into 40 into 2 divided by 1,000. It is 400 contracts. Okay, so we are having 400 contracts. Total contracts, how much we are having? We are having total of 730 contracts. Okay, so what contract is it? It is short, right? So this was the information which was given in question, and we have just calculated one thing. Okay, we have to find out profit or loss to Ram. Okay, now what is given here is that the share of X Limited dropped by 2%. Okay, so X Limited share. Okay, I am taking this long position. Okay, sorry, not long position, it is spot value. Okay, spot means he is already having that share, he has already bought it. No, so we are calculating the profit or loss in it. Okay, when the share of X Limited drop by 2%, means what? 2,20,000. 22 minus how much? 2% into 10,000. It is 21 lakh. Sorry, 2 lakh 15,600. Okay, Y Limited spot how much? And A's share, this is not Y, this is A. Okay, A, and A Limited share appreciated by 3%. Okay, means what? It went up by 3%. So 40 plus 3% into 5,000. sorry, the profit no here, minus 2 lakh. It is 6,000 here, and above it will be above it is 4,400 negative. Okay, here it is positive. And hedging short, I'll show calculation here. Okay, so how many contracts we had? 730 into how many units? It is 50, right? 50 into, sorry, minus, sorry, into only will do, into how much? 1.5% negative. Okay, so 730 into 50 into the bought price, sorry, 1000, no, what am I doing? 1000 minus into 1.5%, 1000 into 1.5% into how many contracts? 730 contracts, no. So this should be my profit. 1000 into 1.5% into 730. So I have gained how much? 10,950. So what is the total profit? It is 10,950 plus 6,000 minus 4,400. It is 12,550. What is happening here? कुकुर मुता पंख देके उड़ा चला जाए रे. It is easy question. Why are we doing it wrong? Why is it 70 contracts? See, we already had 220. Okay, 2 lakh 10,000 into. Okay, so here 10,000 into 22 into 1.5 divided by. Oh man, what are we missing here? Yeah, it's right only, no? Acha. Here there is a minus sign. Okay. So 400 minus 330. We would have already gained a hedge only. Okay. So what concept are we applying here is that if we take a position of 330 in the shares, okay, 330 we need for only X limited, and A limited we are requiring 400 contracts. Okay, so 330 and 330 is nullified. Okay, and for we just need extra 70 contracts, so is equal to 70. Okay, so just 70 contracts we need. Now we'll get the answer. 1000 into 1.5, 1000 into 1.5% into 70. It is 1050, and here plus 6,000 minus 2650. No, man, what is happening here? See, up till 70 contracts it was right. Thus 70 future contract need to be obtained to for complete hedge. Cash outlay. Okay. 2,20,000 minus 2 lakh plus 70 is equal to 90. Okay. So Y limited also it was selling only, not long. So this is short and this is long. Okay, so that's where we went. So 6000 plus 4400 minus 1050, it still come to 9350. I'll show it in my book, fair book. My goodness, this is all in recording and I'm making mistakes here. Question number, which question is it? 14, right? See, buy we had 10 lakh 22, beta 2 lakh 20,000, sell we had 2 lakh. Okay, for X limited, index future was 330 short, and for Y limited 4,000 net future we have. Acha, that's why it was long. Man, we had here 400 was long contract, here it was short. We understood the question differently. Okay, so that's why it is 70 contract. Okay, man. Okay, 70 long. Overall gain or loss on future, it is how much? 70 into 1000 into 1.5%. 70 contract we took of 1000, so 1050, right? Loss on X limited, so everything loss only. 70 is what? 70 is my long, 70 long. Okay, 70 long. So this is also in negative only. So 4400 plus 6000 plus 1050. It is 11,450 and it's matching now. Okay, all was lost. Just read the question carefully. That's what I'll say. Read question carefully. We'll move on to the next question and hope to do it rightly. Question number 15 is a good question. Okay, it is star mark here. We'll see what it is. And with open eyes. The details of portfolio is given. Okay, number of shares, price per share is given, beta is given. Okay, the investor thinks that the risk portfolio is very high and wants to reduce the risk portfolio beta to 0.91. Okay, so he wants a risk of 0.91. Okay, he is willing to take a risk of 0.91. He is considering the two options below. The first one is to dispose of a part of his existing portfolio to acquire risk-free securities. This we have already discussed in portfolio chapter. Okay, we have discussed there and said that it is a concept of derivative and we left it there. Okay, so what it is, we'll see. He is considering two below mentioned alternative strategies, that is to dispose of a part of his existing portfolio to acquire risk-free securities. Okay, so the first thing we are required to is find out portfolio beta. So how do you find out portfolio beta? It is number of shares into price per share. We'll get total market value. Okay, and we'll give weight to it into beta. Okay, we'll get a total beta and that total beta will be my portfolio beta. Okay, it is very much easy. Next we have to find the value of risk-free securities to be acquired. Okay, so the portfolio beta we are getting here is 1.3. Okay, the same steps. It is 3 lakh shares into market price, value of share, percentage, that is weights we are getting, beta, and the total beta, portfolio beta, we'll get the portfolio beta. Okay, so now the value of risk-free securities to be acquired. Okay, so how much beta does he want to keep? Okay, so it is how much? Question number 15. How much beta does he want? He wants 0.91. What is the existing beta? It is 1.30. Into what is the value of security? It is 5 lakhs, 5,000 lakhs. 5,000 lakhs. Divide by one future contract, right? So 5,000 into 1.3. So, man. Question number 15. Risk-free securities is equal to what? This concept I'll just revise once again. It is in portfolio chapter. See, in portfolio, disposing of some risky securities and portfolio and acquiring risk-free securities. Questions in derivatives. This method is used only to reduce the beta of portfolio. Step 1 to calculate. Okay, weight of risky portion in the portfolio. So required beta divided by existing beta. Weight of risky portion. So weight of risky is equal to required beta 0.91 divided by existing beta. It is 1.30. Right. So weight of risky portion is how much? 0.91 divided by 1.3. So it is 0.7. Weight of risk free is equal to 1 minus 0.7. It is equal to 0.3. Okay. So what is the total value? 5,000 into 0.3 will get 1,500 lakhs as risk free securities. Okay. Now next step we have to do is, what is the next step we have to do? It is the amount to be disposed of from risky securities from portfolio to acquire risk-free securities, that is existing market values into weight of risk-free. Okay, we calculated this. Okay, next step is amount of securities of each company to be disposed of. Step 3 into weight of each security in the portfolio. Okay, so now what we'll do is that we got the total amount, okay, into the weight of securities. Okay, now what was the weight of securities? It was 0.3, 0.6, 0.1. Okay, we'll dispose of that much securities from each of the shares we have. Okay, so from A Limited, 1,500 into 0.3 we'll dispose of 450. Okay, so 1,500 into 0.6 from B Limited and 1,500 into 0.1 from C Limited. Okay, so total we get 1,500. Okay, so how much we are getting? 450, 900 and 150. Okay, this much we have to dispose it off. Okay, we solved this part. Okay, the number of shares of each company to be disposed of. Next, the number of Nifty future contracts to be bought or sold. Okay, so how do we do it? 5,000 into required beta minus this only, no? Yes, divide by, this is what? This is existing beta. Your normal question, okay, divide by minus required and divided by the number of Nifty futures. It is how much? 8125 into how many Nifty futures? The multiple of 200. Okay, so we'll get it. So how much is it? 5,000 So it is 120 contracts, right? It is 120 contract. Okay, the number of future contract to be bought. The value of portfolio beta for 2% rise in Nifty. Okay, the value of portfolio beta for 2% rise in Nifty. So what is beta? Beta is equal to change in security divided by change in market. Right, so this is how we calculate beta, right? So my existing beta is 1.30 and my change in market is how much? 2%, right? So what is my beta of securities? Change in securities how much? 1.3 into 0.02. 2.6% change in Nifty. Okay. So what will be the beta? 2.6 divided by 2. So it should be 1.3. Oh my goodness, it is wrong. Okay. So we'll see it from the solution only. 2% rise in Nifty. No. So what will be the value of beta, portfolio beta? 2% rise. Question part 5. Okay, value of portfolio beta for 2% rise in Nifty. So gain we are getting 91 lakhs. How? Loss in Nifty 8 into, this is very much basic. Okay, we had 120 contracts into 8125 into 2%. Okay, we had booked short position, it went up, so it is loss. Okay, loss on gain on portfolio. Loss or gain on portfolio, it is 1.3, 2% into 5,000. So we are getting 130 lakhs of gain in portfolio. Okay. So totally how much we are getting? 91 lakhs gain. Okay, what is the total portfolio beta? It is 91 divided by 5,000. Okay, so we will get 1.82. What is the portfolio beta? 1.82 divided by 2%, it is 0.91. I'll explain it to again. Firstly, what we are doing is that we are finding out loss. Okay, so gain we already got here. Okay, loss, it should be in bracket. Okay, loss we had 39 lakhs on Nifty, and gain on portfolio. Gain in portfolio, how much we had? Why we are using existing beta? Because we just took out hedging. For hedging we took that this beta, normal beta. Here, sorry, required beta we took for hedging. Here we need not do that. Okay, already we have beta of 1.3 only. Okay, 1.3 into 2%, 2.6 we have into 5%. Okay, so 2.6 into 5,000. So we are getting 130 lakhs gain. Okay, so gain on Nifty. So why are we doing this? Because a change in market into our beta is the actual value we'll get. Okay, means if beta moves by 1%, if market moves by 1%, our company will move by 1.3%. That is the basic funda here. Okay, so gain of 91 lakhs we got. Total portfolio beta is what? Now we are using change in securities divided by change in market. Okay, so beta we don't know. Change in portfolio we are finding out. So how do we calculate it? It is 91 lakhs divided by 5,000. Okay. We are just taking out the percentage change. Okay, percentage change in portfolio. Percentage change is how much? 91 lakhs change has occurred, no, divided by 5,000. So it is how much? 1.82%. So what is the beta of portfolio? Is equal to change in security divided by change in market. Change in security is how much? 1.82. Divided by change in market, it is 2%. So we will get 0.91 only. Okay, it is my required beta only. Okay. Next we take is question number 16. A trader is having a portfolio. In its portfolio, shares worth rupees 85 lakhs at current price and cash 15 lakhs. The beta of the share is 1.6. After 3 months, the price of share dropped by 3.2%. What is the current portfolio beta? Okay, so can we calculate the current portfolio beta? So how do we calculate it? See, beta of portfolio is what? beta of portfolio, one formula was this: change in security divided by change in market. Another formula is weight of securities into weight of market, right? So what is my weight of portfolio? My portfolio is having 85 lakhs worth of shares, okay, into which is having a beta of 1.6 plus, and the cash is also there in the portfolio, okay, 15 lakh cash. Its beta is 0 only, okay. So what is my total portfolio beta? It is 85 into, sorry, we have to 85 divided by 100, okay, divide by 100 here, okay, 0.85 into 1.6, this is 1.36 plus 0, okay, that is equal to 1.36. 1.36 is my portfolio beta, right? So portfolio beta after 3 months, if trader on the current date goes for long position on 100 Nifty futures, okay, so we'll use the same formula only, okay. So beta of portfolio is what? Change in securities divided by change in market, right? So what is my beta of portfolio? It is 1.36. The second part we are solving, okay, the portfolio beta after 3 months. They are asked us that portfolio beta what it is, okay. So firstly, if you would have taken portfolio beta after 3 months, if we had taken a long position, okay, we are taking a long position but the shares have dropped by 3.2%, okay, means what? We are facing a loss only, okay. So what is the gain or loss? First we'll calculate that to find out the percentage change in the portfolio or market, okay. So gain or loss is how much? 100 lakhs we had, right? For 100 lakhs we had long position. So we had to find gain or loss. So how do we find out gain or loss? We have to find out how much is the percentage change in securities. Sorry, percentage change in market. Percentage change in security we know. It is how much? It is 3.2%. So 0.032 also I can write. So change in market will be how much? So change in market. I'll take the change in market this side. Change in market is equal to 0.032 divided by 1.36. So it is how many percent? It is 0.032 divided by 1.36. So 0.032 divided by 1.36. So I'm getting roughly, wait a minute, 3.2 divided by 100. .6, not 36. 0.032 divided by 1.6. Okay, so it is how much? 0.02 or 2%. Okay, 0.02 or 2%. Okay, so it is 2% change in market. Change in market is how much? 2%. Okay, so what is the actual? Now he had taken a long position. Okay, 100 lakhs position he had taken. Okay, so how much was it? 100% he had. Okay, and how much was the change? Minus 2%. Right. So what is the value now? 100 into 98%. It is 98 lakhs. Is the value now. Gain or loss? Loss of 2 lakhs. Right. 2 lakhs loss he is having. Okay. Now we have to find out portfolio beta. Okay. We got this. We got gain or loss. Now we can find out the total value. Right. Now we can find beta. Beta of portfolio is what? Change in market. Sorry, change in security divided by change in market. Right. So change in security is how much? $3.2. Change in market is 2%. Comes to 1.6 only, but it's not right. Okay, Why it is not right, I'll tell you. Because this is wrong. Okay, this is wrong. Why? Because this 2 lakh, we already had how much? 85 lakh shares plus 15 lakhs. 15 lakhs of what? 15 lakhs of shares we had. 15 lakhs of cash we had. So now what is the value of cash? It is only 13 lakhs. That is 15 minus 2. Okay, 13 lakhs we are having. And 85, this 85, it will become what? It also dropped, no. It also dropped. So 85 minus how much? 3.2%. Okay. So it comes to 85 minus 3.2%. It is coming to how much? 82.28%. Okay. So 82.28 plus 13 lakhs is equal to 95.28 lakhs. Okay. So now this is what? 95.28 lakhs. This is my value of portfolio. Okay, so 95.2 is my value of portfolio. What is my change in portfolio? My change in portfolio is, first I had 100 lakhs minus 95.28 divided by 100, right? So minus 100 divided by 100. So it is 4.72%. Okay, now I have to find portfolio beta. Okay, so portfolio beta is what? Change in market, change in portfolio. Change in portfolio, that is how much? 4.72 divided by, what is my market change? It is 2, right? So 4.72 divided by 2. So 2.36%. Okay, both are in percent, so we'll get answer in percent only. Okay, so 2.36 is the portfolio beta. Okay. So why is this wrong? Because this is change in shares. Okay, we had not taken into account the total value. Okay, so 15 minus 2 lakhs we had to do. Okay, so this was wrong. Okay. So I guess it's enough for today. Next we have arbitrage using futures. We'll see it in the next lecture. Okay, till then, tata, bye bye.